Today we're sitting down with short-term rental owner Annette Grant, who also happens to be the co-founder of Thanks for Visiting, where she helps educate fellow hosts on how to launch and run profitable short-term rentals. Annette is curious about how she can leverage her own portfolio, as she also has questions from other hosts who are looking to launch another short-term rental property. If you thought about looking into an investment in the short-term rental space, this is a great episode, so let's get into it.
We want to buy our next deal. We want to get our next property. And the cash reserves, they're low. They're not where they need to be. I don't have the percent I need to get my next property. And the market right now, I feel like, is shifting. A lot of people are going to be putting their places up. And I don't want to miss out on this opportunity. I know our community doesn't. Let's talk through what are these avenues. Help me. Help us buy our next property.
Let's get there.
So I want to start here. I have a small amount of cash ready for the next property. I've already taken a HELOC out. Well, actually, let's go back there. I have a small amount of cash. I'm looking at my next property. Let's go through all the different scenarios of how I can, maybe I only have 5% ready and I need to get to that 20. How can I do that?
Okay.
Let's mix it up.
So first off, I want to say thank you to all the Thanks for Visiting community. We've talked to a ton of people, had really great conversations. And it's fun to kind of figure out where your guys' headspace is. Because the investor community is so different from one avenue to another. And the Airbnb community has a completely different outlook. And so we want to really position you guys with loan products that allow you to scale your portfolio if that's what makes sense. So you talked about a HELOC. So I would say almost all of our investors tend to start with pulling a home equity line of credit on their primary residence.
Okay.
So again, a lot of people own their homes, have been in their homes for 5, 10, 15 years, have gained a ton of equity, especially in this ever-growing markets throughout the nation, honestly. And that is a really great way to access probably where most of your net worth is. Mm-hmm. Here in Ohio, we have a lender that goes up to 100% LTV. So 100% of the equity that you have in your property, you can get a line of credit for. Now, I would say like nationwide, you're probably looking at closer to like 90 to 95% is what they'll go up to. So don't get too excited, but that is a perfect way to kind of sit back and be like, where's most of my assets right now? It's probably in your primary residence.
Okay. And that should be how quickly, like, let's say today I'm like, wait, what the heck? I haven't even thought about taking a HELOC out on my primary. How quickly can I get that assessed? Can I see what's available to me? What's kind of a time frame on that, do you think?
So LFG doesn't offer home equity lines of credit. So again, we're a mortgage brokerage that focuses solely on investment real estate.
Who's best to call? Who my current?
Credit unions are great.
Okay, great.
Or keep it simple. Whoever you bank with currently, make a phone call. Wherever your checking and savings accounts are, give them a ring, have a conversation, see what their terms are. I would say most of those loans or lines of credit tend to close in about 3 weeks.
Okay.
It all comes down to their appraisal process. Some of them do desktop appraisals, meaning that they don't even come out to the house. They put your address in a computer and it pops out a value. If that works, if that gets the deal done quickly for you, sweet, awesome, move on. If you're wanting a more strong, accurate number on your primary residence, and they can do a full appraisal, which takes a little bit longer.
And just listening to this, it sounds like this should be something that anybody that's interested in getting their first short-term rental, their second, third, like,
you should have it.
Do this work right now.
Yeah.
It doesn't hurt to do the work to have it available to yourself if you're wanting to buy.
You don't pay interest on it unless you use it. Exactly. Right. Sometimes there's like an annual fee of $100 or whatever, but to have access to, let's just say hypothetically $100,000, I'd pay $100 any day of the week for that.
To just know that's there, ready to go, deploy it if you need it.
Yeah, exactly.
All right, so that sounds path of least resistance. You got some cash.
But just to clarify, no one's really doing HELOCs on investment properties. So I get that question a ton of people being like, well, I have this investment property that I own free and clear. That's not really a thing. I'm not saying no one does it. Feel free to ask. It's better to ask and the answer be no than not ask at all. But generically speaking, after COVID, almost all banks stopped doing HELOCs on investment properties.
So rare to get that on your second or your vacation home.
Yeah. And so a lot of cases, what we've been kind of advising clients of is to maybe some of these people have some really sexy interest rates on their investment properties right now. And so that's why they're really considering HELOCs, so they could keep that low interest rate on their investment properties. Let's have a conversation about that. I mean, again, all these decisions are subject to the borrower and their risk tolerance and their goals and everything like that. But all I can say is let's look at the numbers and really figure out what the difference in your monthly payment is from keeping your 3% interest rate to going to where current interest rates are now and looking at how much cash you can get and what you can do with it.
Right, because let's say I have, which one of them we do have on a property, we have the 2.75 or whatnot. And then let's say primary residence, you have the 3. Would you advise looking at a cash out refi on both of those just to see? I mean, it doesn't hurt, right? To understand the numbers?
I would probably put a HELOC on the primary.
Okay.
And then take cash out on the investment.
All right. So let's think so just in this couple of minutes of chatting, we might have opened up, hopefully, this treasure chest.
Some dollars and cents.
Of money where if you have not looked into the HELOC on your primary, and then secondarily, a cash out refi on your current short-term rental. And we know you might be, really clutching to the low interest rate, but you are advising at least let's look at what cash could be pulled out, get you into that next property, and really kind of zoom out and look at the numbers over a long term, not just be so focused on that one percentage rate.
Well, and my concern is I feel like there's investors that are holding onto that interest rate because it's great. I don't deny any of that, but they're also limiting their potential. And so a lot of these are decisions that a borrower would make. It has nothing to do with our loan products. It doesn't have anything to do with us personally as a company. It's let's look at this and say, okay, if I could give you $50,000, what could you do with that $50,000? What cash flow would come from that? And what's the difference in this payment that we're talking about? The cool thing is it's dollars and cents. It's all math. We're going to give you the equation. You're going to look at it and say, nope, run for the hills, not comfortable doing that. And that's okay. Or I could give you a calculation. You'd be like, I'm crazy not to do this.
Right. I can still get that. It's all just buying money.
Yep.
And it's buying money over time at a different rate. So it's kind of just looking at that. That's something I'll be honest, I haven't heard anybody, because everyone is out there kind of like, it's kind of a badge of honor right now of like, oh, I got my house this interest rate. I've got this interest rate. So in there, there's I feel a lot of fear around it's irresponsible if you're buying now at a higher interest rate. But I think also historically looking over time, those rates were.
Yeah. I mean, my grandparents gave me hell when I said I was mad about my 4% interest rate, and they had perfect credit, plenty of assets when they bought their first house at 14%.
Right.
And we're not there at all.
Right.
We're not there at all. And so we also talk about the concept of the rate's somewhat temporary. So, okay, we refinance you now at this higher rate, but it gives you the cash to continue growing your portfolio. If rates drop, that doesn't stop you from considering those options at that time. But does the transaction still make sense for you? Does the deal, does your Airbnb still cash flow in a comfortable way with the cash out? And then what will that look like for the future deal? So there's moving parts to this. This isn't a simple, yes, you go do this. Right. No, it's going to come down to really what their goals are overall. And we really try to, at LFG, focus on what the goal is for the borrower we're speaking to, and that'll change. Like even us, the two of us, if we were to look at our goals for the next 10 years in regards to real estate, they'd probably be completely different.
Exactly. And change
a
lot over those years. Okay. So what we've been talking about is essentially just us bringing this, as the primary owner, bringing the cash.
Yep.
Let's chat a little bit about, okay, I am tapped out. There's no more cash to be found. And I know people are hesitant. There's some people that are like, other people's money, other people's money, other people's money. I'm that type, like, oh no, I want to do all the things by myself. Let's talk about bringing in some partners.
Yeah.
And bringing some of that cash where they don't necessarily need to be an equity partner. More of that partner is just a person that becomes the bank.
Yeah, I'd actually say we'll probably kind of lean towards two different concepts. So a lot of people are hearing in the market seller financing. Totally an option. Not something LFG is going to help you with, because again, you're working directly with the seller. You're establishing a mortgage.
My friend just got seller financing last week.
And there's a lot of uniquenesses. To be honest, I don't know that I could even pinpoint, oh, it's typically like this, because it's whatever the seller agrees to. Right. So could the seller agree to no money down? Potentially. Could the seller agree to 10% down? potentially. And the interest rate is subject to whatever is negotiated. The term tends to be shorter because the seller doesn't really want to have that loan outstanding
Right.
with you forever.
But it gives you time.
But it gives you time to own the property, kind of work, set up the Airbnb, get it functioning, get that cash flow rolling, and then you can consider other lending options. But a lot of people are talking about that. So again, it's not something we can help with, but it's something you should keep in your back pocket as to something that can be done. And then the second concept is, do you bring in a business partner? So a lot of the conversations we had with Thanks for Visiting Students was, I'm not in a cash position that I'm comfortable with right now to buy something myself. How can I use products that'll allow me to get into a property sooner rather than later? And so that was the concept of, maybe you bring on a financial business partner. And I say that in kind of two different ways. Yes, they could have ownership interests. You could really, work them into the LLC that you establish, probably a new LLC. Let me make that very clear.
Right.
You don't want to muddle the LLC that you already have established with other properties, but set up a new one, figure out that relationship, and kind of balance out the roles, however that would look.
For sure.
Secondarily to that, you don't have to give equity away. And I think that's where a lot of people get scared is, gosh, this is my baby. This is like
Right.
what I put together. I don't know that I really want to muddle that with another person. And I say, you don't have to. Some of these private fundings can happen just on a promissory note. Now, your person has to be comfortable with that and
Right.
not having potentially ownership in the property or a lien position on the property. But you'd be surprised. I would say very, very often do I know of individuals cutting checks of $50, $100, $200,000 to privately fund deals because they're getting paid handsomely. So know
Right.
that structure will have to be super advantageous for that person, but it always comes back to, does the deal still make sense even with these factors in place?
And that part of the financing, I think that's where I always get I'm like, oh, well, they're going to want to have equity. They're going to want to have it. A lot of times, like, no, they want the deal to be very straightforward. Hey, I'm going to loan you this 50K, 100K over the next 3, 5, 10 years. This is a percentage rate, and that's a wrap.
They want
that's
it
what
simple.
They want to do. Yes, they
So
want it simple.
You almost have to
and guaranteed.
Yep. You almost have to sell yourself. And if you offer equity from the jump, well, then now you're stuck
Right,
giving equity.
right.
So slow play it. Figure out. And honestly, a lot of these people that you would be privately funding from, look in your sphere. Look at family, look at friends, look at people that you've done, business in other capacities in the past, because they already trust you because they've worked with you before.
Right.
They have that vow of confidence already. Start with those people, and then you'd be surprised that can expand and expand and expand as you continue to show you're a reliable borrower. You pay your payments timely. They see your success.
Yep.
I mean, it can get.
I love it. We have Mike, one of our coaches. He actually has like a brag binder. So every time he pays a lender back, he has them write a letter.
Wow, that's cool.
like, hey, this is the deal that I did with Mike. I do it over and over again. And he like brings that to the table when he's talking with other folks. So I want to wrap this up because this is the thing we were talking before we got started. It spoke to my soul, especially like real estate investors. Let's talk about goals because I believe the deal can be structured anyway. You can work to find cash. Hell, you can just get a second job, a third job, and like get more cash. But let's talk about the goals and starting there instead of just with the deals. Because I think that's where we get on these like runaway trains of like, oh, I want to have 5 properties, 10 properties, 25 properties. And we don't have the long-term goal in mind. When you're chatting with investors, when you're talking about the loan products, do long-term goals come up? How do you advise on looking at that and like reverse engineering the deals and all the doors?
I mean, honestly, I start there. So again, a lot of the products that we're going to advise of, the strategies we're going to put in place have nothing to do with the loan products. It has to do with who are we speaking to? What are your goals for the next 5, 10 years? How do you want to achieve those? What's your risk tolerance? Honestly, most of the guidance that we give in regards to loan products is based on figuring out what kind of borrower we're working with and what is best for them. Because the process itself, as stressful as it is, getting it set up, buying the property, doing all these moving parts, that already has its natural stress. Let's not add lending to be a stress for you. Let's figure out how we make this so easy that you want to do 10 of these if that's your goal.
Right.
And that's the big thing. I think too often, and I don't think it's wrong, I think it's just different for everybody, is the investment community naturally is have as many doors as you possibly can. And that could be someone's goal, but it doesn't have to be everyone's goals. Figure out what that number is. Maybe it's hey, I want to retire in 5 years and replace my income. Maybe it's, I want to have this much passive income in the next X amount of time. A lot of it will be based on your long-term goals. And so let's talk about it. Put pen to paper, as there's always there's a statistics about, writing a goal down makes it even more achievable. Let's figure out what that really is, and then let us be your lending partner that positions those products accordingly so you can make these goals happen.
All right. And before I think even that next purchase, that next lending adventure, it is figure out your risk. Not, you don't have to know it completely, but let's get some ideas on it, especially if you have a partner that need to have that conversation. And then what are those long-term goals? And then it's like, start working backwards. And that's like, book the call with Liz. You can go through it, figure out if there's a product available. And if there isn't, this is, I think, something that stops a lot of people too, is go ahead and always be looking and having those conversations. So you're prepared when the perfect one comes across your
Even
phone on the Zillow app.
If it's 6 months from now, if it's 12 months, 18, 24 months, that doesn't matter. We can put a calendar invite and say, cool, we're going to touch base in 6 months and see if your financial picture has changed. Because actually, there is a statistic about every 6 months, someone's financial picture changes. Maybe you got a new job. Maybe you got a promotion. Maybe there was appreciation on your primary residence and now you can put a HELOC in place. It's all these moving parts. And again, we're your partner. We're going to be there throughout the process to ensure that you do eventually hit your goals. We're not in any rush to get you there. It's the pace and play of this is all up to them.
All right. So book a call.
Let's do it.